industry in India, recent trends and key PSUs. The oil and gas sector is among the 8 core industries in India and plays a major role in influencing the decision making for all the other important sections of the economy. India's economic growth is closely related to its energy demand, therefore, the need for oil and gas is projected to increase, thereby making the sector quite conducive for investment. India retained its spot as the third largest consumer of oil in the world as of 2023. India is expected to be one of the largest contributors to non-OECD petroleum consumption growth globally. The consumption of petroleum products has increased from 158.5 million metric tons in the fiscal year 2013-14 to 234.3 million metric tons in the fiscal year 2023-24. High-speed diesel was the most consumed oil product in India and accounted for 38.6% of petroleum product consumption in FY23. India's consumption of petroleum products stood at almost 4.44 million barrels per day in FY23, up from 4.5 million BPD in FY22. India's crude oil production stood at 2.69 MBPD during April-October 2023. India's LNG import stood at 30,917 million metric tons between April 2023 to March 2024. According to the International Energy Agency (IEA), consumption of natural gas in India is expected to grow by 25 BCM, registering an average annual growth of 9% until 2024. India's domestic crude oil production stood at 4.89 MMT during April-May 2024. The key crude oil suppliers to India are Russia, Iraq, Saudi Arabia, the United Arab Emirates, and the United States of America. In this short video, we will look at the recent developments in the oil industry. We will do such updates on about 20 different industries, roughly once a quarter. Key PSUs in the oil industry in India and their performance in Q2 2025. Number 1. Oil India Limited. Oil India Limited is an Indian PSU engaged in the business of exploration, development and production of crude oil and natural gas, transportation of crude oil and production of liquid petroleum gas. The company was founded on 18 February 1959 and has its headquarters at Duliajan, Assam. Q2 highlights: the company's crude production improved by almost 5% year-on-year in the quarter ending 30 September 2024 and was at 0.875 million metric tons MMT. The half-year crude production was up by 5.5% with the output of H1 2025 at 1.746 million metric tons compared to 1.655 million metric tons in H1 24. The company has a target crude oil production of 3.6 million metric tons for the current financial year FY25. Natural gas production was also up by 4% and stood at 1.617 BCM billion cubic meters in H125 compared to 1.55 BCM in H124. Natural gas production in Q2 was down by 1.36% and stood at 0.799 BCM compared to 0.810 BCM in Q2 24. The primary reason attributed by the management for a dip in production was due to NTPS Namrup Thermal Power Station and LTP's shutdown, which were in Q2 and were shut for 10 to 15 days. Consolidated financials at a glance. The company clocked a revenue of Rs 88,868.9 million for the quarter ending 30 September 2024, witnessing a quarter-on-quarter decline of 7.5% and a year-over-year decline of 3.5%. The company's EBITDA saw a quarter-on-quarter decline of 2.5% and a year-over-year decline of 15.8%. The EBITDA for Q2 stood at Rs 32,866.2 million. PAT for Q2 was Rs 20,691.6 million with a quarter-on-quarter increase of 2.6%. The EBITDA margin in Q2 was over 37% and in Q1 it was 35%. The PAT margin has also improved since Q1, which has jumped from 21% to 23.2% in Q2 2025. PAT in Q2 2024 was lower on account of an exceptional amount of Rs 23,668.4 million. The half-yearly average price realization for crude was $82.9 BBL, which was down from $82.22 BBL in H1 24. In Q2 25, the average crude oil price was $79.33 BBL, which was down by 8.6% year over year from $86.86 in Q2 2024. Natural gas average price during Q2 2025 was $6.5 MMBTU, which was more or less stable in the last few quarters. The company has seen improved margins due to falling crude prices, and with the current crude prices, the margins are likely to sustain in the near future. Operational highlights. During the quarter, the company got 9 geographical areas (GAs) allocated, out of which 3 are already functional in Haryana and Maharashtra. The company's biggest refinery in Numaligarh is going under an expansion with an estimated cost of Rs 280,000 million. During the year FY25, Oil India has a target of drilling 70 plus wells in Rajasthan, Mahanadi Basin, and offshore regions of the Andaman and Nicobar Islands. The planned capital expenditure during the year is expected to be around Rs 70,000 million, out of which Rs 20,000 million has been earmarked for exploration and production, E&P, and drilling activities. The company is expanding its pipeline linking Numaligarh refinery to Duliajan facilities in 2 phases with an estimated cost of Rs 4,330 million, which has the completion date of March 2026. Number 2, Bharat Petroleum Corporation Limited (BPCL). Bharat Petroleum Corporation Limited (BPCL) is an Indian PSU that is engaged in the oil and gas business with its headquarters in Mumbai. The company was set up on 24 January 1976 and currently operates 3 refineries in Bina, Madhya Pradesh, Kochi, Kerala, and Mumbai, Maharashtra. The company is India's second largest government-owned downstream oil producer, which comes under the umbrella of the Ministry of Petroleum and Natural Gas. Q2 highlights. The company witnessed an increase in the consumption of petroleum products by 4% in H1 2025. Diesel consumption grew by 0.9%, petrol by 7.2%, and ATF grew by over 10% in the first half of FY25. BPCL saw growth in market share of 0.1% in Q2 2025 in the MS Retail Motor Sprint Petrol and a 0.12% gain in the market share in HSD High Speed Diesel. The company expects MS retail demand to grow by 6% and HSD by 1 to 1.5% in FY25. A rapid shift to CNG has caused a dip in HSD consumption, and the transition from HSD to CNG is likely to continue further. Financials at a glance. The company clocked in revenue from operations of Rs 11,79,520 million for the quarter ending 30 September 2024. The profit before tax or PBT was Rs 31,940 million in Q2, which was 20% lower than Rs 40,320 million in Q1 and more than 70% lower than Q2 2024. BPCL's PAT for the second quarter was Rs 23,970 million, which was also 20% lower than Rs 30,150 million in the first quarter of FY25. The year-on-year dip in PAT was over 71%, and PAT for Q2 FY24 stood at over Rs 85,000 million. The company has a planned capital expenditure of Rs 1,60,000 million for the year, out of which Rs 56,620 million have been spent so far. During the quarter, the company distributed over Rs 56,000 million as dividend to its shareholders. The company's debt at the end of the second quarter was valued at over Rs 2,15,000 million, which is a 40% increase on a quarter-over-quarter basis and a dip of 4% on a year-over-year basis. During the quarter, BPCL suffered rupees 11,000 million in marketing losses and rupees 21,040 million in LPG losses on the back of higher LPG prices. The LPG losses are expected to be covered, and the company anticipates LPG losses to remain around rupees 10,000 million for the year FY25. Operational highlights. During this period, BPCL's refinery throughput, the volume of crude oil natural gas that flows through, was 10.28 million metric tons, which was higher by 1.7% on a year-on-year basis and almost 10% on a year-over-year basis. During the quarter, BPCL's refineries were operating at 114% of their nameplate capacity. The company's distillate yield was 84.33% during the quarter, which was lower by 1.2% from Q1 2025 when it was at 84.57%. On a year-over-year basis, the distillate was up from 84.6% in Q2 2024. BPCL's GRM cross-refining margin for the petrochemicals improved from $0.46 BBL in H1 24 to $0.79 BBL in H1 25. The company witnessed a growth in domestic sales by 1.6% in Q2 when compared to a year-over-year basis. BPCL also recorded the highest throughput for retail outlets among its PSU peers at 151 kiloliters per month, which was 10% higher than the PSU average of 137 kiloliters per month. The company has a robust network along the highways which helped it achieve such a milestone. In the first half of FY25, BPCL commissioned 540 plus new retail outlets, and the total number of outlets is expected to reach 23,000 by March 2025. The company also added 90 CNG stations during H1, taking the total to 2,100 plus CNG stations across the country. BPCL has reached an ethanol blending of 14.97%, and the E20 fuel is available at 4,400 plus retail outlets. The company also commissioned its first LNG station in Coimbatore, Kerala. The second is expected to be soon in Panacheri, Kerala. BPCL's new foray into the refreshment and eatery business, named B Cafe, has reached a total of 22 with 16 B Cafes commissioned in H1 2025. The company has planned rupees 30,000 million for CGD business for the year. The Russian throughput has come down from 39% to 34% during the quarter as some units of the Bina refinery were shut down. Currently, Russian crude is available at an approx discounts of $2.5 to 3.5 than market prices for BBL. During the quarter, the board of directors approved 2 JVs. First JV with Sembcorp Green Hydrogen India Private Limited, a unit of Singapore-based Sembcorp Group in the domain of renewable energy. Number 2 JV with the GPS Renewables Private Limited for setting up compressed biogas plants across India. Hindustan Petroleum Corporation Limited (HPCL) is an Indian PSU in the petroleum and natural gas headquarters in Mumbai. The company was set up on 5 July 1952 and deals mainly in petroleum, natural gas, LNG, lubricants, and petrochemicals. The company is a subsidiary of Oil and Natural Gas Corporation (ONGC), which is owned by Government of India and comes under the ambit of the Ministry of Petroleum and Natural Gas. Q2 highlights. HPCL witnessed domestic sales volume growth during H1 2025 of over 5.5%. Motor fuels grew at 4.5%. ATF grew at almost 20%. And the lubricants segment is witnessing a 5% growth when compared to a year-over-year basis. HPCL's domestic market share increased by 0.78% in the first half of 2025. Overall, the company saw an 8.2% growth on a year-on-year basis. With continuing growth in the lubricant segment, HPCL has written to the government regarding the demerger of the lubricant business and is awaiting approvals from the Finance Ministry and other regarding the same. Financials at a glance. The company clocked in a revenue of rupees 10,87,739.3 million in the second quarter, which is 10% lower on a quarter-on-quarter basis and 5.5% higher when compared on a year-on-year basis. EBITDA for Q2 was rupees 32,142.4 million, which is 22% higher than the previous quarter, which posted an EBITDA of rupees 26,340 million. On a year-on-year basis, the EBITDA was lower by over 60%. The company posted a JV associate loss of rupees 3,920.2 million for the quarter ending 30 September 2024, which resulted in a net PAT of rupees 1,426.7 million. PAT was lower by 77% on a quarter-on-quarter basis and a 97% decrease on a year-on-year basis. HPCL posted an inventory loss of rupees 14,000 million due to falling crude prices. So far in FY25, H1 HPCL has spent rupees 65,900 million on capex, and the planned capex for the year is around rupees 1,30,000 million. Debt levels of the company have risen during the quarter on the back of higher inventory purchases and subsidies on LPG mainly. Falling crude prices have resulted in lower GRMs for oil companies, and the benchmark Singapore GRMs fell from $10 BBL in Q2 2024 to $4 BBL in Q2 2025, posting a 60% dip. The company had reduced PAT margins due to the following reasons: suppressed marketing margins on some petroleum products, falling trend in crude oil prices, reduced refining margins due to lower cracks. Operational highlights. During H1 2025, HPCL refineries operated at 103.7% of their capacity and had a throughput of 12.6 MMT. On a year-over-year basis, the throughput was 8% higher. In the second quarter, the refineries operated at 107.7% of their capacity and had a throughput of 6.3 MMT. The sales volume during Q2 was 11.62 MMT, which was up by 8% on a year-over-year basis. For the first half of FY25, the sales volume was 24.25 MMT, up from 22.59 MMT in H1 24, posting an average of over 7%. The company's refinery in Pachpadra, Rajasthan has reached almost 83% completion, and the DHT hydrogen generation unit is under pre-commissioning. The refinery is expected to be completed early next year and will have a planned refining capacity of 9 MMT of crude and 2 MMT of petrochemical complexes. HPCL's Vishak refinery is undergoing an upgrade with a planned outlay of over rupees 3 lakh million in the residual and bottom upgrade. Post upgradation, the refinery will have a capacity of 15 MMT of crude, up from the current 8.3 MMT, and also enable the production and distribution of BS6 Bharat Stage 6 compliant fuels. During the second quarter, the company commissioned 353 retail outlets, taking the total number of outlets to over 22,500. The company also added 6 new LPG distributors, and the current strength of distributors is at 6,364. The company also, for the first time in history, started exporting its lubricants to the US, and now HPCL is exporting its lubes to over 30 countries across the globe. The company's first LNG terminal of Chara, Gujarat is expected to be operational by the end of FY 2025. The company also reached an ethanol blending of 15.9% in the second quarter. HPCL has also received an order for developing and operating the fuel farm and the in-plane services at the new airport at Bhogapuram, Vizianagaram. HPCL's renewables subsidiary is currently doing 200 MW of power, and the company has a planned upgrade which will double it to 400 MW in the next 2 years. HPCL has estimated an approx investment of rupees 15 to 2 lakh million in the renewables and biofuel sector. Going forward, India's role in global oil markets is expected to expand substantially over the remainder of the decade, fueling by strong growth in its economy, population, and demographics. The recent geopolitical events in the Middle East and the fear of tariffs by the incoming Trump administration in the United States have cast a shadow on the global oil and gas industry. Congestion at most ports and blockages of key shipping routes in maritime shipping are expected to continue in the near future. A steep shift towards LNG is expected by most analysts as the trucking industry deals with tighter emission norms. India is also expected to ramp up its LNG network, and the role of HSD is expected to be reduced. A rise of EVs, especially in the sub 15 lakh price bracket, will cause a dent in sales of ICE vehicles. However, the bottlenecks in the charging infra and the reliability and longevity of the battery tech may be a cause for concern. India's import of crude oil, however, are most likely to increase as the country is going through a phase of economic growth. A shift towards CNG from petrol or gasoline is likely to continue, and with the growth of CGD networks, LPG is going to be replaced in the coming decades.